It is that time of the program where we turn our attention over to the markets. Joining us this week to offer his thoughts and perspectives is Darin Newsome. He is the Barchat Senior Analyst. Darin, always good to have you here on the show. Thanks for taking the time.
Thanks for having me on again, Bryce.
Let's begin in the corn market. What are you seeing there on that front, Darin?
A lot of consolidation for the most part. We're looking at the old crop market. It just really doesn't have any reason to move very far one direction or the other. So I think right now we're just stuck for a little while. We'll see what happens, as we get further into spring. We have entered the second half of the 2023-24 marketing year. And that's usually when corn moves to center stage. We start to see demand picking up. So we'll see if that's the case this year. As for new crop, it's all going to be about weather. As we head into the weekend, there was a lot of forecasts for some rains across, stretching from the Southern Plains to across the U.S. Midwest, particularly east of the Missouri River. And that's the area that's showing the largest soil moisture deficits, at this point in early March. So I think it's going to be critical here early in the spring to start to see some of these rains develop. If not, and we start to see a drier spring and leading into drier summer, that could change the outlook of the market a bit.
Yeah, you noted in your commentary, fundamentally just kind of neutral at this point on the corn front. I want to bring this up to you, Darin. Last week we got news, or perhaps news we wouldn't have news, when it comes to sustainable aviation fuel. To that front, it's about tax credits is where we're kind of sitting in the discussion phase with ag policy. But how important is sustainable aviation fuel, particularly for ethanol, moving forward?
I've heard a couple different parts of this. Number one, it was supposed to be for ethanol. Number two, it isn't for ethanol, that it's for the renewable diesel. So, I think there's a lot to be worked out yet. And again, this kind of goes back to, we're trying to find something. We're trying to find some demand to replace what's been lost. If it is on the renewable diesel side, that would make sense with all of the crushing plants that are going up. Ethanol demand, I think, is still, for corn is still, kind of flatlining. It is a constant where we have feed demand goes up and down, export demand goes up and down. But ethanol demand basically is relatively constant here in the United States. So it'll be interesting to see how this plays out. Is it going to be for ethanol or is it going to be for renewable diesel?
Yep, good point there, Darin. You bring up demand. Let's pivot a little bit, talk about soybeans. Over the winter months, we kept asking, where's the demand for soybeans? Has that changed at all?
Not a bit. And in fact, we just got the update, the weekly sales and shipments update through the end of February. Total sales are still running about 20% behind. The shipments, as far as the projected pace, also about 20% behind last year. So, there's just not a lot there's not a lot of change in demand for U.S. soybeans. Again, China's buying what it needs right now from Brazil. Brazil had a good crop. We can also see it in the May-July soybean future spread. We've seen that spread move out of bullish territory into neutral. We'll see how long that lasts. I think once it goes back into the bullish onto the bullish side of the threshold, and that's going to be an indicator that China might be running shorter on Brazilian beans, might be looking towards the United States. But this is going to be later in the marketing year than it usually happens.
Let's build on the point you're making there, Darin. Read you a headline coming from Bloomberg News this week. China buying hefty amounts of foreign grain as global prices slump. Seems to be most of their buying in South America. Is that the case?
That's absolutely the case. Yeah. And we've got this silly little trade war that's in place, and China's not going to buy anything from the U.S. it doesn't have to buy. Now, it has been buying some grain sorghum. A lot of folks don't, realize that, but we've seen grain sorghum demand pick up this past marketing year, but it doesn't make up for what's lost, particularly in the soybean market. Corn exports are picking up, not necessarily to China, but we've seen Mexico and Japan really increase this year, and a lot of that has to do with we've got bushels to sell. We didn't have them last marketing year because we had a short crop. But this year, we're seeing better demand from some of our old reliable customers. They're coming back to the table. China, still nowhere to be seen.
Okay, shift over to the wheat market. Talking with a wheat producer a few weeks ago at this point. He just notes it's challenging to be one because of these markets. What's the global scene that's led to the challenge? I guess I'll call it a challenging marketplace here domestically, Darin?
It's always challenging to grow wheat. Coming from a wheat farm, I can attest to that. But there are, and it is a global market. You're absolutely right. I mean, this is where we really have to pay attention to what's going on. Reportedly, who knows? But reportedly, Russia's dumping wheat, cheap wheat on the market. We've seen that for the last couple of years. It's got plenty of people still willing to buy. When it comes down to it, price still matters. We've seen weather help Australia have a good crop, and so that's putting more pressure on both the U.S. soft red winter and hard red winter markets. And then as we look ahead towards new crop here in the United States, those same weather patterns that are calling for more rain from the southern plains through the Midwest, it's going to hit a lot of the hard red winter growing area and soft red winter growing areas here. So there's just no supply scare at this point. At the end of February, available stocks to use based on cash price was showing a large increase, not only from last month, but an incredible increase from a year ago. It just tells us that we've got more supplies in relation to demand. And that's not a situation that screams prices are going to be going higher.
I want to get to a viewer question. Steve wrote in. Steve wrote in this week and noted that he uses hedges to arrive and forward contracts for corn and beans, but he asked you to help him understand the appeal of basis contracts, if any.
Yeah, it's interesting. Each one of there's all these different aspects of the different markets. You've got basis, you've got futures, and that leads us to cash. So if you do a hedge to arrive, you usually do those when the futures markets are strong and basis are weak. A lot of times there's an inverse relationship between futures and basis. And then conversely, you would use a basis contract if you've got new crop futures that are down, but end users or terminals are trying to push the basis a little bit to try to get some contracts locked in, to get some bushels locked in. So if the futures market's down and they're pushing the basis, that's where you would lock in your basis on the expectation that the futures market's going to rally. It's going to give you a better chance to price that basis contract. And at the same time, basis might start to weaken as we go through the market year. So there's a time and place for these different contracts. And it's knowing the market, it's understanding what part of the market we're in or where we are with that market that kind of leads us to which one of these contracts to use.